This is a class, an investing club class, but we're going to have a guest speaker from the Bitcoin Club talking to us today, Eric. Eric, I'll let you introduce yourself a little bit, and then we can get started.
Hi, yeah, I'm Eric Kavam, and I'm kind of a, Bitcoin fanatic, so that's why, I'm doing this. I guess I saw the policies for these investment club groups, that we don't want to be, offensive or politically controversial, but some people do view these crypto things as, a form of political activism, and there's different political groups within Bitcoin, or even that would choose Ethereum or whatever. So all that exists. So, and I think it's fine if you have different points of views. It's fine if you don't like Bitcoin, or if you, have different opinions. I just want to go out of the way to say that, these are my opinions, and it's perfectly fine if you, disagree. Obviously that's perfectly fine. So, yeah, so we're going to get started on this Bitcoin thing and talk about what it is and maybe why it's important, why I'm going to make a claim here like saying it's a once-in-a-species opportunity. So we'll go ahead and get started. So, yeah, I kind of gave you the warning, but we're kind of going down the rabbit hole, so some of this stuff is a little bit crazy when compared to the status quo. Or if you think that the status quo is already crazy, then maybe this is actually going to make sense. So it just kind of depends how you look at it. So at the beginning here, we've got how Bitcoin was created, or where it came from. It's a pretty unique story. But even before we have Bitcoin, we have some of these Austrian economists talking about money. And that's really a group that have a lot of interest in Bitcoin. People who already like Austrian economics, or some people who discover Bitcoin subsequently discover Austrian economics, one way or the other. So we've got Friedrich Hayek, who's commenting here way back in 1984 that he doesn't think money will ever be good again until we get it out of the hands of government, but not to do it in a violent way. Instead, in some sly roundabout way, introduce something that they can't stop. So that's Friedrich Hayek. And then a more recent Austrian economist, Milton Friedman, from the Chicago School. This is now we have the internet, and it's 1999, and Milton Friedman saying that one thing that's missing but will soon be developed is reliable e-cash, a method whereby on the internet you can transfer funds from A to B without them knowing each other. And so that's a little bit of a, interesting prediction, because then we've got later in 2008, the Bitcoin white paper getting published. And so the paper goes through the concept of the system, and it didn't come out of nowhere. We find it built on previous systems. So Satoshi didn't really come up with the whole thing himself. We've got prior work from well-known cryptographer David Schwam, and then other work from Adam Back, and from Nick Szabo, and from Hal Finney. And some people actually think that Adam Back or Hal Finney might be Satoshi Nakamoto. No one really knows. No one knows who Satoshi is, or some group of people. So that's kind of interesting. And then shortly after, we have the Genesis block being mined. So this is the first Bitcoin block being mined. So this is kind of the first entry in this ledger or database. And one thing that the Bitcoin protocol is, in addition to keeping track of balances of funds, it's also fundamentally a timestamping protocol. So a message was encoded in the first block. We've got it shown here from the Times in Britain in January, Chancellor on brink of second bailout for banks. And so this quote helps for the timestamping to prove when the Genesis block was published, just like you might have a hostage hold up a newspaper to prove that they're still alive. But then we also have the choice of the message here, which kind of gets at the purpose of Bitcoin, where we've got this banking system that's kind of failing, not working the way it's supposed to. We've got banks getting bailed out, and that was the context here with Bitcoin being created. So from there, we go on to the first open source client getting released, and getting used. We've got some of the first transactions. And now we jump to the present, or at the time I made this, January 13th, millions of Bitcoins were mined by Satoshi Nakamoto, but none of them have been spent. They're widely considered lost. So Satoshi doesn't seem to have given himself any benefit from being the creator. It seems like he was just kind of benevolent, doing this as a volunteer, as a public service. So, yeah, so we've got kind of two radical concepts that can appeal to different people. On the one hand, Bitcoin's kind of radically, you could say, socialist or egalitarian. It doesn't discriminate. It's a public good. It's built by volunteers, available to everyone to use. But then it's also radically capitalist in that it protects these property rights. So it's a little bit of both. It's a public good, but at the same time, it's protecting property rights as this new digital property that's been created. So that's fine, but now we want to get into some of these basic mechanics of Bitcoin. I've already started throwing around words like mining and things like that. So we're just going to start at some of the, technical beginning points, just with some vocabulary, just kind of make sure we all get on the same page here. So first, we're talking about cryptography, and these are open systems, and they use secret random numbers, which are like a password, to provide security. And really, something has to be random in order to be secret. If it wasn't random, then there'd be a way that someone could guess it, just like you don't want to use your birthday as a password. So this is something we're all familiar with now, where you have open systems, but you can define the points where the user uses their password or uses a secret. But the design of the system can be known by everybody. So we've got a private key. This is something that can be used to generate digital signatures. So our emails can use this when you sign an email, and that allows people to verify that that the email came from you because you signed it and you're the only one that has your private key. So the public key is what the recipient of the email would have, where they use that public key to identify you, that they check the message and say, yep, the signature matches the public key. So you have a little bit similar with Bitcoin, where you'll be signing a transaction kind of like you sign a check, and that anyone can verify that it was signed by someone that in fact had the funds, and thus the funds get transferred. We have a concept of entropy. This is when your information is physically randomized, like flipping a coin. So that's how random numbers are generated. They need actual physical entropy. We have the concept of a hash. Bitcoin uses SHA-256. But a hash is a deterministic function, so it's not really random, but it seems random because the outputs are unpredictable. So if you put a certain input, you'll always get the same output, but any slight change to the input, you get a completely different output. So they're repeatable, but it's as if they're random. We have a nonce. A nonce is a random number that gets used once. So that happens sometimes in cryptography, they'll have nonces. And then we have Coinbase transactions. So that's what the company is named after that. Coinbase transactions are the transactions that mint new coins. So that's part of mining, which we'll look at next. When a block gets mined, it includes a Coinbase transaction, and that's how new coins get created. So we've got, this is kind of one of the nerdiest charts here, I guess, but this is just for people who really want to get like the nitty gritty of this, that it's not kind of just smoke and mirrors of how these blocks get created, how Bitcoins get created. So, so things that happen in every Bitcoin block, we show a little bit of it here in the top right. Each block contains a hash of the previous block. So that's what forms the chain. So that's why it's called the blockchain, because each block has a hash of the previous block. Each block also contains a nonce, which causes the hash of the block to be approximately 0. So how could you find this nonce such that when you hash the block, you get roughly 0? Well, we said we can't predict what the hash is going to be, so the only way is to do guess and check. So you just repeatedly guess nonces, hash them, check, is it close to 0? If not, guess again. So that's what mining is. Mining is just guessing nonces as fast as you can, hashing them, and then checking. So that's the mining process. So the other thing that we have is a public key that identifies who gets the Coinbase reward. There might also be some transaction fees, but the miner will typically just use a public key that they control. They have the private key to it, and that's where they'll assign the Coinbase reward. That's the reward for mining the block. Mining the block, it takes real resources, it takes electricity and equipment, and they could potentially lose money, but if they're competitive, you know, and depending on the price of Bitcoin and all these factors, they can, it can be profitable. And then finally, the other thing in the block, you'll have various transactions just from other people. Other people want to send money from A to B, and they'll also include a fee that the miner gets. So the miner will choose transactions to include that pay the most fees. I mean, they could do other things too. Sometimes empty blocks get mined. The miners can do what they want, but most of them don't want to lose money, so they'll just try to get the most fees. So we have this concept here of the hash rate. So this is if you take all the miners together, how many hashes per second. And so we're at the point now we're at 200 billions of hashes per second. So this industry is real. All of these hash solutions are called proof of work. So we have proof that it's real. There's no way to fake it. We know this hashing power is out there, and you know, you see it firsthand in these industrial facilities with big racks, mining equipment, usually where there's energy production nearby. And yeah, so I'll go on a little bit. So we could think about the first block that was mined, the Genesis block. Doesn't matter what the nonce was, there's no previous hash, and that Coinbase transaction paid Satoshi Nakamoto a reward of 50 Bitcoins. As was written in the white paper, that's what the initial block reward was. It was 50 Bitcoins. So then block number 2 is going to reference the Genesis block as the previous hash, and now it has to actually be mined, so they have to find a nonce that that makes this block roughly 0. And how close to 0 it has to be is satisfying what's called the proof of work difficulty threshold. It's not realistic to get exactly 0, but it has to be close enough. And then again, that block paid a 50 Bitcoin reward. So we talked about how that nonce was determined. It's through this mining process of guessing solutions and checking if the hash of the resulting block is close enough to 0. But a key thing is that difficulty threshold, it's dynamic. And it's dynamic so that if a block gets solved in less than 10 minutes, then the difficulty threshold increases. So the numbers have to be closer to 0. And if the blocks take more than 10 minutes to get mined, then the difficulty reduces and it becomes easier to mine blocks. So that's why even as the Bitcoin price changes and the amount of hash power that exists is always changing, we still, on average, get a Bitcoin block every 10 minutes. So the system stays stable. So it's this closed loop dynamic difficulty. So the end result is that we have this lottery that pays out a reward every 10 minutes. And from the white paper, we get this schedule of mining that says that every 210,000 blocks, which is nominally 4 years, the reward cuts in half. So where we started with this reward of 50 Bitcoins, 4 years later, it cut in half to 25 Bitcoins per block. And then 4 years later, it cut to 12.5. And then it reduced to 6.25 Bitcoins. And that's where we are today. The current block reward pays out every 10 minutes, 6.25 Bitcoins. And the next halvening is expected to happen in February 2024. This was May 2024. It's actually always changing a little bit depending on the block time, so it keeps, getting revised. And at that point, Bitcoin becomes scarcer than gold when the reward drops to 3.125 Bitcoins every 10 minutes. So this schedule continues, and then you can see in the year 2140, there's no more mining. So the total Bitcoin supply that will ever exist is 21 million Bitcoins.
2041, year 2041? Or?
No, the year 2140.
Okay.
But right now, we've already mined, I think it's 19 million Bitcoins have already been mined. So there's only 2 million left to be mined. Okay, so that's like a nice concept, but, you might wonder about the security, what prevents miners from, cheating, for example. Why does this work the way it's supposed to and not, fall apart or get corrupted? So fundamentally, the miners are racing to add valid blocks to a valid chain, and the valid chain has to follow rules, like not paying themselves 1,000 Bitcoins, and also being the chain that has the most proof of work. Because if they don't do that, they end up wasting their resources. And so that happens because mining costs real electricity and real equipment. And if you mine a block that's not valid and no one else wants to build on it, then all the work you did hashing is wasted. So you just, kind of wasted your time. And then you could also see if there's a valid block and you ignore it and don't build on it, other miners will build on it, and then you fall behind. And then again, your equipment that you paid for is being wasted because you're kind of losing your shot in this lottery. So the really only successful strategy we have here for the miners to be profitable and not lose money is to play by the rules. So the miners are all keeping each other in check. They don't want to give an advantage to their competitors, so they all kind of keep each other honest. But there's different, attacks that we could think about. We could think about if evil miners just wanted to destroy Bitcoin. If you did that and you compromise the system, all the Bitcoins become worthless, so you don't get a reward. But maybe you're like Goldfinger, you own lots of gold, so you just want to destroy Bitcoin to make your gold worth more or something like that. So there are those kind of external actors that might be motivated to try to destroy the network. And you could think about how much security you get. Like if I paid you $1 million, then how would I know that that's not reversible? So what you could do is look at the cost in that lottery, and we say it was 6.25 Bitcoins every 10 minutes, and then you can multiply that times $40,000 per Bitcoin, and that's nominally what the mining cost was. So you could say, well, that's, maybe $250,000 every 10 minutes. So if I wait 40 minutes, now the cost of reversing my transaction is more than the transaction itself. So then you could say, well, it's economically final because someone would be losing money. If they tried to cheat me, they wouldn't be making money. So that's how Bitcoin provides its proof of finality, that transactions have cleared. And sometimes, critics of Bitcoin point to the number of transactions per second, but what I think is really more relevant is what volume can you provably clear, and how quickly. And in that sense, Bitcoin doesn't really have any comparison. It can clear very large transactions and settle them quickly. And even if there was some kind of mining attack, everyone would be able to see it. So even if miners got control of the network and did all kinds of invalid things, and that blockchain had the most proof of work, people could still choose to ignore it. That would be kind of a breakdown of the system, but not necessarily one that can't be recovered from. So anyway, so those are kind of the extremes of the security model and the ways it could break down. So at the end of this, we have a whole different type of security model where previously property rights have been based on people having to, maybe cavemen had to defend the property themselves, but people form a legal system that gets a monopoly on violence, which means if people break a law, they get arrested by police, and that's what defends people's property rights. So most of the time, you wouldn't have to guard your house or anything like that. It's registered in the legal system. So Bitcoin introduces these digital property rights that don't rely on the legal system to secure them. Instead, they're secured by cryptography and your ability to keep a secret. So it's true that in extreme cases, someone could threaten you, just like they could threaten you for a password, they could threaten you for your Bitcoin keys. But fundamentally, Bitcoin is working. It's effectively securing property rights, and maybe it's starting to get some backing from the state in different jurisdictions. But by and large, it hasn't had that support, and it's still been very effective. And there are ways you can secure your Bitcoin with multi-sig. There's different mechanisms that you can make it that someone wouldn't even be able to get your Bitcoin even by physically attacking you, so there'd be no point in doing so. So then we get the system that works everywhere in the world, regardless of the jurisdiction, because it does not rely on the legal system to function, and so it allows people to have commerce and trade and pay each other no matter where they are in the world. So that's kind of what's really different here about anything that has existed before by having this, you know, virtual or digital asset. So a digital asset that I would call software-defined digital gold, it's most like gold because it's mined. It's a little bit different than gold because the supply is predefined. It's not just like people finding it in the ground wherever, you know, the natural deposits are. So some of these laws are actually defined by the, you know, it's a rules-based system. And this system has been very effective at preventing cheating. That's fundamentally what I view it as. It's a system that prevents cheating, and it does so by providing proof that there's been no cheating. There's proof of work, that none of the miners cheated, and the structure of the database traces every Bitcoin back through all of the people that have held it back to when it was mined. So it's fundamentally the system that's very auditable. It provides proof and traceability, and it's very easy for anyone to verify that. You don't need an intermediary. You don't need to log into some website or ask someone. You can run the software on a low-cost computer and verify it for yourself. Also, unlike gold, this system evolves. The software makes updates over time. There's been SegWit and Taproot and different protocol upgrades, which is not something that that gold can do. And so far, all the Bitcoin updates have been backwards compatible. So it's upheld its own rules. Bitcoin has not broken its rules, but it's still managed to continue to improve itself. Other advantages over gold: it's easier to store as long as you can keep a secret. It's easier to transfer just by signing a transaction. You can send any amount to anyone in the world in a matter of, you know, in a matter of an hour. And it's much easier to authenticate, where with gold, you have to do an acid test or something like that to verify that the gold is authentic. The cryptographic verification is easy to do. So,
Is that the same as the audit, or that's different?
no, it's the same as the audit.
Okay.
Yeah. Because not only can I see that the Bitcoin you sent me, that you actually were the owner and that I was the owner, so you can verify property transfers occurred. You can also audit the entire network to see that the currency wasn't debased, that the real supply is only 19 million, that no one's cheating to create inflation. So you can audit it on a network level and on the individual property level.
I'll scoot closer to the mic, because I don't know if everyone heard that question.
So also the network scaled incredibly well. You know, I liken it to like a cockroach. The miners, it could be your phones that are mining Bitcoin. If somebody, like if the military attacked all the industrial mining facilities, then all of a sudden you'd be able to mine, you know, with your phone. So the system can easily just go underground and keep running. The different miners don't even need to be aware of each other. They don't need to register. It's permissionless. There's no master list of who's the participants are. It works even if the network is big or small, and the communication requirement is only 4 megabytes of data every 10 minutes. So you could imagine somebody taking over some jurisdiction, trying to eliminate every computer that has any internet connectivity. It would be extremely difficult. So even
I have a question about that then. Is the computing or processing, you said 4 megabits per second?
Or megabytes, but yeah.
Or megabytes per second. Would that ever increase over time? Like, is that going to be?
That's actually been an extremely controversial subject in Bitcoin. So we mentioned Bitcoin politics back in the 2007 timeframe. There was a group that wanted to make the block size bigger, so like 8 megabytes. And it used to be 1 megabyte, so they kind of made some compromises, but fundamentally, the group that wanted to keep the block size small was because then it starts to become that people have to have these high-power computers, which most people don't have. So that causes the system to become more centralized, where only maybe larger corporations can run, you know, they call them full nodes, these nodes that have the ability to audit the whole network. So by keeping the block size smaller, it makes it easier for anyone to audit the network. The trade-off is you can't fit as many transactions per block. So there's a fundamental trade-off there. So something that's unique about Bitcoin compared to voting like say, like in a democracy or as a shareholder in a business, is that minority shareholders are naturally protected from censorship, debasement, and seizure. All the miners are fundamentally minorities, and they're all protecting other minorities. So it's not a system of majority rule. We have new innovations that allow payments to go through off the chain. So this helps with that block size limitation not being an issue. There's kind of some innovations here that allow this payment routing network to get layered on top. And the payments actually act like packets where they deliver information in addition to the payments. And so it's starting to be used to send messages, and it's actually a potential replacement for IP addresses and the internet as we know it, that this Lightning Network can be a way that anyone can become an internet service provider and get paid for routing packets or pay for their packets to be routed in a permissionless way. Current internet, you need to get assigned an IP address from the central authority in order to participate. So this would be a permissionless information routing network. It's already starting to form. But fundamentally, this is a form of money. So like any money, it's solving this global coordination problem where some people want to save and then spend their money later in a different amount on anything they want, anywhere they want, but that global consumption and production have to be equal. So on a global level, production always equals consumption, just like everyone buying a Bitcoin is also someone selling a Bitcoin in exact equal amounts, but on an individual level, I might be saving Bitcoin one year and then spending it a completely different year in a completely different place. And so, but what this does is, because this isn't a central bank setting interest rates, it means all the collective users of the network and whatever their needs are, their individual needs to save or their need to spend, is what decides the price. So if we all decided that I need to have 6 months worth of funds in my account and I'm not there yet, and we all decided we needed to save, well, if everyone felt that way, then instantly our money in our accounts would be worth more. But the savers are in contradiction to the spenders that say, they're like, I have plenty of money, I want to spend this, what's the point of saving it if I don't spend it? So that's, that is kind of causing this kind of mutual negotiation of what's the price at any given moment, what's the reward for saving versus spending. And so it ends up rewarding, if you save when everyone else is spending, then you're doing this kind of public service by accommodating other people's needs, and you'll be buying when the price is low. Likewise, if you spend when everyone else is saving, that's also helping to accommodate everyone else's needs, but then you'll also be getting a good price because you'll be spending it when the price is high. So if you're prepared, if you want things at your convenience, it'll cost you more. If you're willing to do things at the mercy of the market price, which is at the convenience of others, you get rewarded. So it's the fundamental nature of this free market money. So this chart is all for addressing what they call FUD. There's some, FUD, hodling, there's different, acronyms. So FUD is fear, uncertainty, and doubt. So that's something that comes out in the crypto space. So one of the criticisms is the volatility. I talked about that a little bit, like why it's actually useful to have some. But we have someone here noting that you can't be the best performing asset and also not be volatile, because if you were, everyone would want to buy it, and then it would go back to being volatile again. So it's inevitable that as this asset, with people mortgaging their houses to buy Bitcoin and all this leverage and all these people anticipating future adoption, all that speculation, it's going to be volatile, and it is, especially in this early adoption phase. Another one of the accusations is the amount of illicit activity with Bitcoin. Silk Road used to exclusively use Bitcoin for payments. But this study that was commissioned by some people from the CIA found that the illicit use has really dropped off, and that since 2017, there's actually, as a percentage, the conventional system actually carries out more illicit activity than Bitcoin does. And then I just Googled myself to make this table listing cases where financial institutions lost cases where they were sued for laundering money for criminals. So this is actually, happens to the tune of billions of dollars where the entire market cap of Bitcoin is less than 800 billion, you can see this is more than the entire market cap of Bitcoin being used to serve terrorists and criminals by financial institutions. So we've also, I see there's something in the chat. I don't know, let me see what this is. Okay. Given the hash rate, how could you verify the miner that finds the first valid solution? Could there ever be a tie? Yes, this does happen. You do get these little splits in the blockchain where you'll have, someone mined a block, and then shortly after, someone mines the same block, but they have even better proof of work. So as part of that lottery, those are cases where you'll actually fail to get the reward. So to really see a transaction settle, you probably want to see more than one block. Just because you see one block mined your Bitcoin transaction, it could get reversed because of those kind of effects. A rule of thumb is that people wait an hour, which is 6 blocks. That's kind of a rule of thumb if you really want to know your Bitcoin transaction settled. Although really, even if your Bitcoin transaction got reversed, like it was in the recent block, and then it got subsequently, pulled out, it will probably get back in there because it's still in the queue and it will get processed. As long as you're not worried that the person paying you is trying to cheat you and they're double spending the money, then they could play some games. So if you don't really trust the person who's paying you, you might want to wait an hour. Okay, so yeah, Bitcoin's been declared dead ever since it was created. It gets declared dead multiple times per year. It's kind of fun to read those obituaries because in hindsight, they're pretty silly. We get the criticism that Bitcoin isn't backed by anything, but that is the point because that's why there's no counterparty risk. If we were tracking a database that tracked gold, for example, the database could get out of sync with the physical commodity. Because you're directly auditing a proof of work database, the database itself is providing the proof. So auditing the database, there's no other underlying physical asset to audit. So that is actually the whole point of it. So then we have energy use. Bitcoin mining does use a lot of energy, but if you compare it to other things, sometimes it gets compared to countries and it's like, oh, this is more energy than Panama uses or something like that. But if you compare it to gold and mining, we see Bitcoin is 79 terawatt hours per year. Gold and mining is 265. So it's a fraction compared to gold, which it sort of, maybe competes with. Finance and insurance, just having all the existing financial office buildings and ATM machines and, credit card and check printing machines, it's a lot more power than what Bitcoin mining uses. And then you could even compare to some degree to the military-industrial complex. I don't think Bitcoin makes the military unnecessary, but maybe a little bit less necessary, at least for some things, because maybe people have some part of their property that doesn't rely on a nation state to protect it. So I don't view it as being an issue with, environmental concerns. In fact, Bitcoin mining has helped a lot with renewable energy. In Texas, like I have a friend in Dallas that gets 10 hours of free electricity every night because the wind keeps blowing and they have so much solar. So that was unusable, but now Bitcoin mining is using that electricity at night, and that helps pay for the renewable energy production. It's also being used at locations where there's flare gas, where normally they would just burn this natural gas when they want to get to the oil because they're stranded and there's no pipeline. Now they can run that through a generator, and they can mine Bitcoin, and after you run the gas through a generator, there's actually less harmful emissions. It just wasn't worthwhile to do so. So now it's becoming, profitable to actually do these things that help the environment. So that's been my finding. So here's this last one. This is all just kind of addressing the FUD that the Bitcoin network is kind of lacking the technologies that other types of crypto assets have. And that's true if you just want to limit yourself to looking at the main chain. It's just, the main chain is just that 4 megabytes every 10 minutes. Although even as originally created with that limitation of 7 transactions a second, that's actually similar to Fedwire, and Fedwire underpins the US dollar. So as a competitor to the US dollar, even if Bitcoin never changed or never upgraded, it appears to already have what it needs. as the underlying base layer. But Bitcoin is changing and evolving. I've got some different projects cited here, like Stacks and Counterparty and RGB, that are being used to provide, NFTs and scaling solutions to allow more transactions and DeFi and, allow for ICOs and all that stuff. So that stuff is being done on Bitcoin. Bitcoin does have some limitations to experimentation. People are careful because they don't want to, they want it to never break any of its existing rules. So Bitcoin is still set up that you could bury your keys in the ground, dig them up 100 years later, and you could still use them. They're very careful not to change the rules so that everybody will have to rush and go do something for this to continue working under the old rules. And the Lightning Network here is particularly interesting because this is the one that allows the routing payments as packets as this other layer, and it fundamentally interoperates with all the other assets. So I could send a Lightning payment, and for you to receive that payment, you had to send me Ethereum or some asset on a different blockchain. It could even be that you sign a contract on the Bitcoin blockchain on paper, however you sign it, saying that that you want to sell me your car, and that if you release this pre-image, it means that I own your car, and then I can commit a Bitcoin payment to you that you get the payment as soon as you release the pre-image. Thus, you release the pre-image, ownership of your car changes, and the payment gets received. So it allows all these kind of atomic swaps to happen, all with this Lightning Network. So it's a really good interoperability layer and a scaling layer that I think it had 100,000 users last year, and now this year it has 80 million users. So it's blowing up fast. So this whole page here is just kind of this is all criticizing other approaches that are really different from Bitcoin. So we've got some criticisms of proof of stake. Proof of stake is a big technology breakthrough, or like a computer science breakthrough. It was called the Byzantine generals problem. So that was previously unsolved before Bitcoin, but now there's also more solutions that are coming out that are really different than Bitcoin that also solve this problem. And it's kind of like if you have, sometimes at work we'll have the expression you have to get all the liars in the room together, because sometimes you get different information from all these communication channels and you can't tell what someone really said because you have other people reporting on what someone else said. So that's why you have to actually get Congress to meet together in Washington, D.C. so that they all can see each other face to face and know who said what and who voted for what. There's not really another way for them all to know what the other people said and all of that consensus unless they all get in the room together until some of these computer science breakthroughs. So now it's possible with some of these algorithms to get that same effect of people voting and forming a consensus and everyone knowing what the consensus was, even if everyone's on their computer and they're not in the room together. So it is a big breakthrough, but it's not something that I see as what I want to have controlling the world's money. And so some of the reasons here for that are you don't have an objective reason for a particular quorum of people, which group of people should be the ones whose vote counts. If you do this as proof of stake, then you've got a plutocracy where it's not really democracy with one vote per person. It's like shareholders in a company where it's based on how much you own. And so I don't think that's a good way to manage the world's money as a plutocracy. It's good for other things though. So I think it has its applications, but I wouldn't view it as a competitor to Bitcoin. It doesn't scale. There's communication overhead. All of the shareholders have to be able to talk to each other, and they have to know the list of who all the shareholders are. So it doesn't scale like the miners, which were permissionless. In terms of cheating, it's easy to create a fake history. You can do it instantaneously, whereas Bitcoin does have that time factor as a time-stamping network where there's no way to generate the proof of work in a shorter period of time. So yeah, I'm critical of when people try to take those things and actually compare them to Bitcoin and act like they can solve the same problems or do the same things. I think they're really different approaches that are appropriate for very different types of problems. So then, yeah, comparing to Ethereum specifically, Ethereum, the founder, we know who it is. It's Vitalik, unlike Satoshi, who's anonymous, and Vitalik controls the Ethereum Foundation, which subsequently controls all the miners. because there's something called a difficulty bomb that only the Ethereum Foundation can diffuse. So if the miners don't do what Vitalik wants, all he has to do is not diffuse the difficulty bomb, and they're all out of business. So they're constantly under this threat of coercion to have to do whatever Vitalik says. And initially there was a 60% pre-mine, which means 60% of Ethereum went to the foundation. Only 40% of it is mined. So when people compare the market cap of Ethereum to Bitcoin, it's not really apples to apples, because no one actually had to mine that. To have a perspective, let's say that I spontaneously create 1 million Eric Kavam tokens, okay? Then let's say that I sell one of them to Austin for $1. Does that mean I'm a millionaire? All I did is sell one token for $1. So I would have to think about that kind of logic when you look at this pre-mine, that is it really worth as much as they say when no one had to mine 60% of those tokens? So yeah, fundamentally, Ethereum's continued to change. It's been, I mean, in a sense, it's been radically successful. They've done a lot of innovative things, and they've got a lot of adoption, and I think they're continuing to do interesting things, but it's really the opposite of Bitcoin, where Bitcoin has never changed its rules, and Ethereum's continued to change its rules as it experiments and tries different things. And as an investor, I'd be pretty concerned, because Ethereum could be regulated as a security, because it is going to this proof of stake model where they're like shareholders that are expecting a return on their investment based on fees from the utility it provides to its users. So it becomes a lot like a for-profit company with shareholders, and that's a pretty big regulatory risk. And so far, looking at how much fees they generate and what the price of the tokens are, it didn't look like a competitive PE ratio, but that could change in the future. Obviously, a lot of these tech companies, when they start out, are not profitable, but if they become so in the future, like Amazon and Google, they kind of start off, losing money. So that's kind of how I look at Ethereum, as like one of those tech companies where you're anticipating some kind of, becoming profitable in the future. So yeah, we started off talking about Austrian economics, and so that really is the backdrop here for why Bitcoin's relevant. If we had sound money, there'd probably be no reason to be interested in Bitcoin, but we don't. So here we got some charts from the St. Louis Fed. We've got the velocity of money, which you see is actually changing a lot. It goes from 4 to 11. If you don't know what the velocity of money is, that's like if you count all the supply of money and the dollars that turn over per year, how often does the entire supply of money turn over per year? So it's like that many times per year. So we can see things changed when we had the financial crisis, and velocity of money declined, and then it fell off a cliff when we had COVID hit. So you can see I see a lot of signs here that the system as we know it is actually it's clearly broken at this point. It's clearly not working. We can also look at the money supply, which had this steady linear trend throughout our history, and then suddenly deviated with the 2009 crisis, and then even more so, where we went from $1 trillion money supply to now up to $9 trillion, and you can see the rate that it's growing now. So. And this, having in mind that the Federal Reserve is insolvent, they've been insolvent since about 2015. It happened because mortgage-backed securities and other things that they bought, defaulted. And so on their balance sheet, their assets are bigger than their liabilities. And I'm sorry, the liabilities are bigger than their assets. Yeah, sorry. And some people, think, oh, that's fine. It's not a big deal. But, because you can't have a run on the bank, and you don't have a run on the bank in the conventional sense, because whether you go to Chase or Wells Fargo, whichever bank you choose, they all tie back to the same central bank. When you have a run on the central bank, it's because you're choosing to hold a different currency instead of dollars. So if everybody decided to hold euros or to hold Bitcoin or something like that, that creates the run on the central bank, and all of a sudden you realize that those dollars, can't be redeemed. And we do have these structural deficits, which the Federal Reserve is monetizing. And we have the fact that a lot of the assets on the Fed's balance sheet are treasuries, and they already had the interest rates go to zero. There's nowhere to go but up. And as the interest rates go up, those treasuries become worth less. And so fundamentally, the Fed becomes even more insolvent. And now we have this inflation. So we see here, calculating inflation, they changed the way they calculate it. They changed it in the 1980s. They changed it again in the 90s. If you calculate inflation the same way it was calculated in 1980, you see that our inflation has actually passed 15%. It's not the worst in 40 years. It's the worst since 1918. The only way that they can argue that it's the worst in 40 years is because they changed the way it was calculated. So if you calculate it consistently, this is unprecedented inflation. The only way the Fed can try to tame that is by raising rates, but raising rates causes them to become even more insolvent. And we've already seen monetary policy starting to become impotent, where it does not have the effects it used to have in the 80s. The Fed is raising rates and it's not having those proportional effects. So the Fed is starting to become, impotent and irrelevant. Unfortunately, because it would be good if they had the power to solve all these problems, but it doesn't seem that they do. And then here we just have a little bit of history of different major currencies in the world. And so historically, it's actually not, unusual for the reserve currency to change. Ray Dalio has written about this. He's expecting the next currency to be the Chinese as the world order is changing. I personally would rather have, Bitcoin than have the Chinese currency because because of the authoritarian Chinese Communist Party. But this is actually, pretty normal for the reserve currency to transition and change. And it hasn't been that long that we've been on this fiat experiment. It really is an experiment, and it seems clear to me that this experiment is reaching the end of the road. We can look at what happened in 1971. I don't know, does anybody know what happened in 1971? So 1971 is when we came off the gold standard. That's when Nixon temporarily, if you listen to his speech, he temporarily stopped redeeming US dollars for gold, but we're still in the same temporary state in 2022. And you can see this caused a big disconnect between productivity and compensation for workers. It also had this, here we say the extreme differences here are real GDP per capita kept going on trend, but all of a sudden real median weekly earnings stagnated. And they've continued. And now if you look at the rate of inflation we have in real terms, we're already in a recession. We've been in a recession since COVID. We haven't come out of it. And we're raising rates in the middle of a recession, which is like what happened in the Great Depression. So the Federal Reserve has been identified by many as the largest contributor to inequality, to wealth inequality, and sometimes in the past has even caused wars. So this, to me, this experiment, hasn't really gone so well, and I think it's reaching the end, which is what's happened before. If you look at, Rome and other currencies as they get debased or eventually go to fiat, those are usually precursors to having a new currency get established. So, yeah, so here we had Jerome Powell, now we've got Ben Bernanke here, we've got Janet Yellen. So these are some of the major people who kind of run the, the Federal Reserve or at the Treasury. This is kind of actually a fun picture of Janet Yellen getting photobombed by somebody. We've got a quote here from Ben Bernanke. This is at the time that he was the chairperson of the Federal Reserve. He was in that role during the financial crisis around 2009. And he was at Milton Friedman's funeral. Milton Friedman actually got a Nobel Prize for finding that it was the Federal Reserve that had caused the Great Depression through their monetary policy. There were other contributing factors, but he found that was really the most significant contributing factor. And this was kind of validated by Ben Bernanke, saying that you're right, we did it, we're very sorry, but thanks to you, we won't do it again, because now monetary policy is based on Milton Friedman's work, understanding the relationship between increasing the money supply and inflation. So this is some pretty strong validation, and I've seen other quotes from Jerome Powell that he expects that the U.S. is going to go back to being a multi-currency nation as it was in its future, in its past. So even these people who, and Janet Yellen's recently had more favorable, comments about Bitcoin. So I think even these people that are, kind of running the system, they're aware of the problems in the system. These aren't stupid people. I think these are, very smart people that understand what's going on. So we're at a point now where we have this proliferation of Bitcoin. We have, ExxonMobil mining. We've got hedge fund managers like Ray Dalio endorsing it. We've got Michael Saylor and MicroStrategy putting this on their balance sheet now as a corporate treasury reserve. We've got El Salvador adopting it as their national currency where it's being used on the street. We've got publicly traded companies becoming the world's largest ATM network. We've got satellites in orbit now that can beam down these transactions to gas stations that don't have internet service, much like they do for credit cards, so that even in remote places, your transactions can be processed. And we're seeing adoption in parts of the world where you might not expect, like Nigeria, Vietnam, Philippines, and Turkey being the countries where adoption is growing the fastest. And you could see that because in the U.S., compared to other places, we do have a more stable currency and better property rights.
Question, do you know if Tesla is still using Bitcoin as transaction?
Last I heard, Tesla wasn't accepting Bitcoin as payment, but they were still holding it on their balance sheet. They didn't sell it.
Okay.
Well, they sold a little bit to prove that they could sell it, to
Okay.
test the liquidity of the market, but after their test transaction, I don't think they sold anymore. Yeah, we've got even Intel now getting into the mining game to create ASICs. And we've got Kraken getting their bank charter. There's another bank in Wyoming. There's Level. So it's getting to a point that you can open a conventional payment account the same way your grandma would, except they're going to be offering Bitcoin because these institutions are, Bitcoin institutions are getting bank licenses, and now they're becoming voting members of the Federal Reserve System. They're actually part of the system, and they're bank supporters, much like Cynthia Lumens, a senator in Wyoming. We've got, politicians that are joining this. So it's becoming part of the establishment. So here we're looking at our technology adoption curve comparing the internet, which is in on the bottom scale. No, I'm sorry. We've got the internet in white here, and so we're seeing adoption of the internet from 1992 to 2006, and then we're looking at adoption of Bitcoin starting in 2016. So we see that where we're at with Bitcoin adoption is similar to where the internet was in 1997, except that Bitcoin's being adopted even faster than the internet was. Then we've got looking at Bitcoin's price history on a log scale. You really have to look on a log scale to see anything. And we've got the halvenings with this 4-year cycle. And that's really the kind of way to look at it, looking at Bitcoin on this 4-year cycle, not as a short-term investment, and looking at it on a log scale. So as this adoption grows, we have something called Metcalfe's law. So most of the models for evaluating Bitcoin view it as a network, like a phone network. Instead of how many people you can call, it's how many people can you, send and receive payments to. So the network becomes much more useful as it grows. So we're already seeing that happen where we've got Lightning Network being used to transact in dollars, British pounds, or altcoins, but you have this underlying network that's the common, standard that lets everybody do commerce regardless of even what asset they're using. So we not only have Bitcoin as the asset, we have Bitcoin as the network growing. And if you want to look at Sharpe ratio, which is a way to take, risk-adjusted returns on an investment, you can compare Bitcoin just from its, volatility versus its returns, and we see that it's got a better Sharpe ratio than Amazon, Facebook, Apple, Google, bonds, gold, S&P 500. So what this says is that even though Bitcoin's volatile, you'd want to have some portion of your portfolio allocated to it. If you're risk averse and you say this is too volatile, you'd allocate a smaller portion. But this is saying you wouldn't want to allocate zero, just based on what it is. You can still manage your risk. If you allocate 1% to it, you can't lose more than 1%. So you can manage your risk by limiting how much is allocated. And then in terms of the market cap of what the total addressable market here of what Bitcoin's going after, it's huge. You could compare Bitcoin to gold. We know Bitcoin becomes scarcer than gold in 2024. If you look at the stock to flow ratio, it's about 2% of the world's gold supply that gets mined every year. Bitcoin, it's a little bit more than that. But when the next halvening happens, that's when it actually becomes scarcer. So we could see that the potential for gold to be displaced here just because of technological utility and scarcity. And then you can look at all the other forms of money, whether you're talking about treasuries, bonds, money supply, even things like Social Security. This is a huge market that Bitcoin can displace, and that Bitcoin might even grow the amount of money that gets used. As it becomes scarcer, money just becomes better, where there's more cases where you'd rather have this kind of financial instrument instead of an equity. So I think it's going to take a bigger piece of the pie of all money, and it's going to actually grow how much people want to use money and own it.
Yeah, I'm going to interrupt right now. So we're getting short on time here, and I know there's probably questions out there, and I'm kind of feeling like we should probably have a follow-up class or session to this to finish up with questions, to finish up your presentation. Does that sound okay to everyone? Yeah, all right. I would love to have a follow-up.
Let's see, I can see what these chats are. Yep,
Okay.
I got some yeses.
Yes. Just for the sake of ending on the hour, I would like we should probably schedule something for the next, I don't know, in the next week, next couple weeks, maybe within the next month. What do you think, Eric? To continue this, and maybe everyone that has, I'm guessing people have questions right now. So what I would say is probably write down your questions, get them to me or Eric, and then we can schedule a follow-up. Eric can finish this presentation, and answer all the questions at the same time. Yeah, we'll have copies of the slides, and this is also being recorded as well. So yeah, thank you, Eric. If you wanted to have last 1 minute wrap up, go ahead, and then we'll stop it on the hour.
Yeah, sure. I'll see what I got on the charts here. So this is just saying a lot of people think that they're too late. I've had people all through these years, 2018, they say they're too late. 2019, they say they're too late. I guess, so my message is, I don't think it's too late. I think it's still very early. I think these trends of the halvenings, if you look at the prices when the halvening is happening, I think the whole adoption trend is only accelerating. So I think it's actually still at a very early phase. I don't think it's too late. I think the end game here is not that you're going to be able to necessarily have to sell your Bitcoin one day. I think as it gets adopted, you won't have to sell it. I think that's kind of the beauty of this. So yeah, this is the end of the presentation, but maybe this is the beginning. If this is something you're interested in, you might just be the beginning of going down the rabbit hole, because there's no one's ever found a bottom to it yet. So as far as we know, it just keeps going.
All right, well, thank you, Eric. We'll have more communication out later about this.
Good, thank you.